Our videos have been looking at the areas of financial management. We've talked about treasury management in terms of looking at accounts receivable, so people who owe you money, accounts payable, you owe them money, and managing the cash flow in your organization. We've looked at capital structure management, so we've been looking at using debt and equity for the organization, and so we looked at a number of financial ratios as we looked at those different aspects. So working capital management analyzes the financial ratios and creates strategies to ensure assets and liabilities are managed effectively. The last topic we want to look at related to financial management is risk management. So risk management is the process of preserving earnings and assets by minimizing the impact of the loss. So those of you who are going to go into financial services, you may end up working in risk management. You will also take courses related to risk management. When it comes to the different types of risk, we have speculative or market risk, and we have what is called pure risk. So speculative or market risk is risk where you voluntarily decide to take on the risk. So, for example, you decide to invest in the stock market, you may lose your money as the stock value changes. So you have voluntarily taken an action which could result in a loss. Maybe you're involved in a risky business deal, so again, speculative or market risk. What we want to focus on today is the pure risk. That is the uncertainty associated with a situation where there's really two outcomes. There's either loss or no loss, and it's not really by your choice in terms of whether you experience that loss or not. So we have property risk, we have liability risk, and we have personnel risk. So we're going to look at those different types of risk in just a moment. But think about what kind of risk, what kind of pure risks a business would experience related to property, liability, or personnel. So what are some risks to a business? And let's see, let's change our pin color here. So risk to a business. Well, the business could go bankrupt, right? You could have theft. So an employee could steal from you. You could have shoplifting. Customers could steal from you. Maybe you have a customer that gets injured at your business. Maybe you get sued. Maybe there is a flood or a fire. Maybe, as we hear a lot lately, there's ransomware, locks you out of all your systems. Maybe there are product liability issues. So maybe there's something defective with the good that you made, and so it then has to be recalled. Maybe there's lawsuits related to that if it caused injury. So these are all risks to a business. And so as we are looking at financial management, we have to decide what is it we are going to do in terms of dealing with these risks. So let's talk about what the risks are, and then let's talk about ways that we can deal with them. So let's start with property risk. So we define real property as land and anything physically attached to it. So you have your land, you have your building, that is the real property for the organization. We also have what is called personal property. So even though the word is personal, it's still owned by the business. The key differentiation here is that it's not attached to the land. So this is your machines, your equipment, your inventory. If you have vehicles, then that's all part of your property. It's just called personal property. When it comes to the property, you could have a direct loss. That is, there's physical damage to the property that reduces its value. Okay, so we have a fire, and that fire destroys the building. It's a direct loss. We also have what is called indirect loss. So indirect loss is where we haven't destroyed the building, but there is a disruption that causes us not to be able to carry out our normal operations. So there is a financial impact to us in terms of the reduction in revenue or an increase in expenses to our organization because of that. Okay. So perhaps there is an incident that disrupts our production, but it doesn't actually destroy any of our property. Okay. So what we look at peril. What is the cause of the loss? Is the cause of the loss natural events? So there is a tornado naturally occurring that destroys the property. Maybe there's a tornado nearby that doesn't actually hit our property, but because of the disruptions that are caused in terms of the power being knocked out, it caused an indirect loss. We aren't able to continue operating for that day. Everything gets paused. So here we are impacted because of that natural event. We can also have human actions. So maybe we have a disgruntled employee that sabotaged a machine and now it no longer works. And so the equipment is broken, so we have a direct loss. Or maybe that simply we need to pull whatever they put into the machine that's not making it work. And so we have lost the ability to carry out normal operations for a period of time because of that sabotage. So all of these are property risk. If there has been physical damage to our real or personal property, we have to look at in terms of, do we look at replacement value or do we look at actual cash value? So actual cash value is the value after depreciation. Okay. So this would be in terms of if we were to sell a vehicle, how much would it be worth? Versus replacement value, which is if I have a vehicle that we use to, let's say we have a transport truck for our services. Let's say we install mini blinds. Okay, we have a truck that goes and takes those mini blinds to where they are installed. If there is an issue, in which case the truck is damaged, do we look at in terms of the actual cash value of the truck, so the price we paid for it minus depreciation, or do we look at replacement value, which is if I had to get another truck to deliver mini blinds, what would that cost me? Well, when we look at dealing with the risk and that financial management related to it, mostly what we see is replacement value. So when you insure your property, typically it's at replacement value. Why? Because actual cash value doesn't give me a truck to continue the operations of my business. What I want is to be able to replace the broken truck with a truck that I can actually use so I can continue my operations. All right, we have property risk, we have liability risk, and we have personnel risk. Liability risk comes from the fact that we might have legal requirements for how we operate. They might be statutory liability. So for example, workman's comp is where we pay for injury or illness, and this could be regardless of who's at fault. So for example, one of the biggest cases in terms of workman's comp was to a company called Marsh & McLennan. Marsh & McLennan was an insurance company that was in one of the towers during 9/11. During 9/11, they lost 295 employees when the towers fell. They were not at fault. It is not a risk they chose to take on. So if we go back to our list here, it's not a speculative or market risk, but it is pure risk, right? So in this case, there is workman's compensation can pay for injury or illness regardless of who's at fault. So company was not at fault, but 295 of their employees died. And so here what we're looking at is a payment to family members. And for 295 people is quite a lot of money. So that was in the death of workers as they were on the job, but workman's comp will also look at if you get injured on the job or ill while you're on the job. We have contractual liability, so perhaps in our agreements with suppliers or people who are going to provide services on our behalf, then we might have contractual requirements. And that contract may agree to cover some of the financial consequences of another party's liability. So if we have that company that is going to deliver and install blinds, and we hire some third-party workers, contract workers, to help us in high demand season, does that contract say then that if anything happens in the course of the business by that company that we're hiring and contracting out the work, that we will be liable? So we will pay for the damages, even though it isn't us who caused the damages or were involved in the damages, but another party that we contracted out. We also have tort liability. So tort liability is where the wrongful act or the failure to provide care results in injury or death. So here's where we were involved in terms of contributing to that injury or death. This can be liability in terms of our premises. Did we do our due diligence to make sure that no one gets hurt at our location? Right? So do we do things like put out warning signs that there was an icy path on our premises, and did we attempt to reduce the ice? So there's liability there. Liability in terms of operations. So if anything happens during our production process where people could be injured, you get your sleeve stuck in a machine, amputates an arm, then we would be liable. There is a cost associated with that. There are professional obligations. So we have associations with organizations that require certain behaviors. So in terms of health and safety standards, there are things like OSHA. There are standards in terms of you're doing food production. There is HACCP, hazard analysis. And so those have certain expectations and certain behaviors that we must follow. So here then we can be liable if we didn't follow those proper procedures and somebody was injured or killed. You might also have professional obligations. So you then, as a lawyer, as a doctor, you get insurance to cover that liability in terms of in case someone dies on your operating table, in case there is injury to someone you are trying to provide services to. We have automobile insurance, right? So here we have payment in case there's an injury or death related to driving a vehicle. And so this would be what vehicles are related to our operations within our organization. We have liability in terms of the product. So if the product is defective, so if we make vehicles and the brakes don't work and people die because the car doesn't stop, then of course that defect in production we are responsible for in terms of injury or death. And that can be in the manufacturing process, that can be due to design of the product, that can be in terms of what we advertise the product could do. So in terms of our marketing and promotion, we sell this product as being able to have these certain features, these certain outcomes, and so we can of course be found liable if it does not. There are tort liabilities related to expectations of the employer in terms of how they behave and in terms of employment practices. So here we're looking at insurance in case there are issues where we have discrimination in hiring, where we have sexual harassment. And so covering the costs, the damages related to those are part of those liability risks. The third one we have to consider is personnel risk, the one we often forget as we list the risk to the organization. Personnel risk considers the impact to the organization if something happens to the employee that's not in the scope of the business. So the other ones we were looking at before were if harm comes to customer or employee during the operations of the business. When we talk about personnel risk, there is an impact to the organization if members of our organization have poor health, if they die prematurely, or if they have insufficient retirement income. So recognizing that these impacts to the employees impact our business. So for example, our CEO, our leader, giving us direction within our organization. If that individual has to take a leave of absence because of cancer, that can impact the profitability and the performance of our organization. If the leader of our organization dies prematurely, and so we're now without someone leading the organization, that has a cost to our organization as well. And so we can actually do things like key life insurance, where we take out insurance as a business on some of our key personnel, so that if there is a loss to the profitability of our organization because of a premature death of one of the key individuals, we can be compensated for that. So the process of risk management. Identify and understand the risks. So what were the three types of risks? We had personnel, we had, what were they? Liability and property. So we have our three types of risks. So we identify and understand those risks. We then need to evaluate the potential severity of those risks. So what will the ultimate cost be to our organization? How likely are these events to happen? Then we need to select a method to manage the risk. So we'll talk in just a moment about what those methods are. We implement the decision, and then we review and evaluate if they are effective in helping us deal with the risk. So what can we do? Well, one is avoidance. Choose not to engage in risky activities. So this comes back really in terms of that speculative or market risk. We're choosing to engage in activities, and so we could then avoid those high-risk activities and then avoid the consequences that come with it. When it comes to more pure risk, it can be more difficult to avoid. And so we are looking then at mitigation, transfer, or assumption. So mitigation. Can we reduce the possibility or severity of the loss? So can we prevent the loss from occurring? So what could we do? Well, if we have a lot of our workforce is doing transport, so we're delivering our blinds and doing installs, could we have driver training to reduce the chances that our drivers are going to be involved in a car accident? Okay, so we're reducing the loss. Maybe we have rules and procedures within our organization, safety rules in terms of how to be around hazardous equipment and dangerous processes, trying to reduce the chance of injury or death. So here we have loss prevention, trying to stop the injury before it happens. Sometimes you can't stop the injury before it happens, but you can reduce the severity of the injury. And of course, any type of injury has a financial cost tied to it. So we talk about shoplifting and theft. What can we do to reduce the loss? Well, a security guard may not be able to stop all shoplifting, but the presence of a security guard does deter some people from that, or could then result in just they're not able to steal as much. So here we have loss reduction. We can't prevent someone from having a heart attack at our business, but if we have people who have first aid training, we can reduce the injury that happens because of that. We can do crisis planning. So we can go and we talked previously in the semester about incident command structure, ICS. We're doing crisis planning. If there is a unique event, how will we respond? The quicker we can respond, the more organized we are to responding to that unique event or crisis. then the less costly the impact is going to be of that. So can we mitigate the risk? Alternatively, can we transfer the cost of the risk? So when we look at insurance, so a number of you will go into financial management, financial services, you're going to be selling insurance. When we look at insurance, we're looking at, can we set it up so that others will pay the financial cost of the loss? Can we get insurance? So automobile insurance, somebody else pays the cost of the damage to the vehicle. We can look at a number of liability insurances to help cover the cost if there's lawsuits, to reduce that cost to the organization. The final option here is assumption. So assumption says, you know what, we recognize that there could be a loss to the organization, and we're going to accept it. We're going to just pay it when it comes. And so maybe we're going to save money by having high deductibles on our insurance. We're going to set aside money in case there are lawsuits, and then we'll have that little nest egg to pay the costs that were incurred. We'll just assume that risk and then pay out the consequences from that. So choices your organization has in terms of how you are going to manage that type of risk. When it comes to insurance, transferring that risk, there is property insurance, right? So you can insure your building, your business against fire, against tornado. General liability insurance, so helping cover the costs if you have any of those lawsuits. Automobile insurance, we talked about before. Workman's comp, businesses pay into, and that's to help cover if there is that personal injury or illness related to being on the job, even if the business is not at fault. We can have insurance related to crime. So we can look at what if it is not shoplifting from customers, but instead it is our employees who are dishonest. So perhaps they are siphoning money off from our organization. Perhaps when we look at so we have what is called funds transfer and social engineering fraud. So in fact, let's just do a quick Google here and talk about the social engineering fraud. So social engineering, and maybe you can't see that. Let's see if I can make it a little bigger. Social engineering fraud, right, refers to scams used by criminals to exploit a person's trust in order to obtain money directly or obtain confidential information. So maybe your employee is not intentionally stealing money from your organization, but they fall for a scam where they become part of the fraud because they are, by their actions, facilitate either a criminal to get access to your organization or to pull money out of the organization. So social engineering fraud, unwittingly, your employees then are part of the crime. So we can actually insure against that social engineering fraud or against employee theft directly, where we're just basically transferring funds out of the organization into the pockets of the employee. We can have insurance against employment practices. So here we're talking about discrimination in, let's say, the hiring process. There can be insurance protection against that. Cyber security, we talked about ransomware. Inland marine, so inland marine insurance is equipment that is away from the premises. So if you have, well, that's hard to read. If you have machinery, tools that are not kept at your business location, they're kept off-site, then you get what is called inland marine insurance. This is equipment that is held off the premises from your operations. You might have professional insurance. We talked about the doctor and the lawyer who would need to get insurance to protect them as they act in their duties, that they might cause harm. Health insurance. We talked before in terms of personnel and how it's important that our people be healthy and have the appropriate amount of retirement so that they can contribute to our organization. And so we, as an organization, provide health insurance, disability insurance. And then we also have, in terms of the company being impacted financially, if there's a loss of a key personnel, that key person life insurance. So in risk management, the last of our 4 areas of financial management, we need to go back to our process to identify and understand the risks. We have 3 types. We evaluate the potential severity of the risk, and we select the methods to manage the risk. Can we take steps to avoid, to mitigate? Are we going to pay an insurance to help us cover some of that cost? Or are we going to assume the cost that's associated with that risk? We implement the decision, we review and evaluate how well that decision is working.